Eh, All right. Joining earlier. I'm so sorry about that. I had to um re live stream what I had before because my microphone wasn't on, and I apologize for that. So I'll wait a couple more minutes to have people join in. Oh man. So my microphone wasn't on and I was babbling for 3 minutes and just realized that. So that's why. Sorry. I apologize. So welcome back to the show. So today, of course, we're just going to talk about GameStop, Black Friday deal, shareholder equities and all that stuff. I want to steer people to kind of focus on the balance sheets, right? And of course, Ryan Cohen, we're going to talk about him a little bit. And yeah, it's just same old, same old. And of course, a little bit about Walmart right now. So again, welcome everybody. Just in case you don't know, this is my thumbnails right here. Of course, we have a Black Friday going on. People who not familiar with GameStop could shop there too. Just in case you're hating on GameStop, saying that they don't do much for the company. Here we go. Have so much deal there. I know people are hating on this company massively, right? That's what the news would love you to think, but check it out. They do have good stuff, good items, good deals, and all that stuff. Okay, so go to the company website, gamestop.com. Tons of deal. There's secondhand stuff if you want to kind of save on those type of thing, but they also have new ones as well if you fancy anything, right? So they have lots of game $6,000. Wow. If you have the money to spend, go ahead, do that. Do it. No, I'm kidding. Do whatever you want, but as far as like deals, yes, there we go. Black Friday. Okay. And then there's nothing news coming in to the SEC filing here. It's just what was the statement of change in beneficial ownership of security. I think those were the buying or selling orders or something. Hold on, let me double check real quick. Yeah, so the awarded shares, right? This is what it means. The share represented restricted stock units, RSUs, from Moore's Daniel William. He's a PFO. Okay, PFO. I'm not quite sure what that is. Again, do your own research. But he was rewarded 6,000. But this is old news since November 1st. Hey, what's up, Lionel? I know. Sorry, I thought I was not gonna go on live, but I saw a whole bunch of hates from GameStop people. From people who are hating on GameStop. So I just want to address this. But I mean, it's the same old story, right? Companies going bankrupt, companies whatever, right? It's the same old things. But anyway, so let's focus on a little bit of the price action here, even though it's not the best. Leading. Hold on one second. I keep forgetting to bring this up. Okay, so this is GameStop price action. Right now we're at 1302. Of course, this is not the focal point. I always maintain that price doesn't really matter. It's psychological at this point. There are people who think that this is overvalued. I think it's undervalued, but there could be a head and shoulder, inverse head and shoulder going on here. As a trader, you know what that means. It means that it could form this type of reversal pattern. So what this would do is you want to look for, this is the head, this is the shoulder, and what you would do is kind of measure from the bottom to this, and wherever it breaks out from, you would measure it to, it could go up to $16, right? So again, this is just a trader point of view. If you want to trade this, again, if you are a investor, you wouldn't care about all this shenanigan. You just, invest in one share at a time, or whatever, how many dollar amount you want to spend on GameStop in terms of share price, right? Because you believe in the company in the long term and all that stuff. But if you don't believe in the company, of course, go ahead, short it, if you want to trade this, whatever way you want to do this, right? Not gonna tell you what to do with your money or anything like that, but me personally, I believe in this stock in the long run. Let's see. So yeah, it's just again, if you want to keep an eye on that one. Not a financial advice, not a a person that know anything about trading at all either. So just from Googling things, I know all this pattern and all that stuff that people are looking for. That's about it. But as for the price action, obviously it's going to be flat for a while. If somebody think that they are, that GameStop is going for bankruptcy and all that stuff, they might continue to short it even more. They believe in the narrative, right? Of course, this type of narrative is strong. But anyway, so let me get off of that topic. So in this one, I kind of look into the balance sheet. I want to focus on the balance sheets. And I keep saying to people, you need to understand what the balance sheets is all about. Now, when people bashing GameStop, they don't really go in depth into why do they think that GameStop is going under? Why do they think that GameStop is going to go bankrupt? And if it wasn't for, meme stock, quote unquote, meme stock investor, GameStop's going to go under. I mean, they might have some merit to that, but again, it's almost like they forget about Ryan Cohen, right? New leadership. Remember, Ryan Cohen just got in here at the end of 2022. 2020. The year 2020. How do I know that? It's because of this letter, okay? So this is when he already have an ownership of GameStop, close to 10%. Obviously, he wrote to the public, wrote a public letter to the board of director of GameStop, laying down everything that they need to do, right, before he become a chairman, right? This is when RC Venture, right here, obtained 10% of the company, right? And trying to turn around this company for the better. Maximize shareholder value. Did he do that? Now, he's been here 3 years, right? Close? Oh, okay. An anniversary of 3 years already. So right now it's 11/18. And this letter was 3 years ago. Okay, 3 full years ago. And did he maximize any shareholder equity or shareholder value? Can he do that? Have it? If you look at the number, did he achieve any of this at all? Right. So let's look at that and kind of refresh the memory of the people to see, or the people who hate on GameStop for no apparent reason, right? To think that this company is going under, at the very least, not profitable. So let's kind of dispel that notion a little bit here. But before I do that, let's summarize what who Ryan Cohen is, right? So this is a Forbes, Forbes magazine or website or whatever, and they are tracking, the success of the people. Now, I know, I feel like Forbes doesn't have any credibility in my mind. It doesn't really matter who was in this Forbes list. It doesn't mean that they're smart or whatever, automatically that they're smart and all that stuff. You have to look into the people individually. The reason I said that is because, Forbes is notorious at kind of elevate Sam Bankman-Fried to be, the next Warren Buffett. Like anybody could be the next Warren Buffett if you're being paid, if you paid this website to prop yourself up. But anyway, they do have good people in there. So again, just because he's in this, it doesn't mean anything to me. The reason why I show you this is because of this snap right here, just to summarize what he's been able to achieve, right? So Ryan Cohen is a former CEO of an online pet supply store, Chewy, which was co-founded in 2011. So 2011. When did he sell Chewy to PetSmart? Okay, let's look at that together. Chewy was sold to PetSmart. 2020, no. Sorry. There we go. Oops. Yeah, let me put this over here. So in 2017, the reason why I show you that, so the year 2017, that's when he sold to PetSmart. And he founded 6 years after that. So that means in 6 years, he was able to grow that business to a $3 billion valuation, right? So he grew the business to $3.5 billion in annual revenue and stepped down in 2028 after selling it to PetSmart for a little bit less. 3.4. I thought it was 3.3, but 3.4 in 2000. It says it right here. What the hell? 2017. Sorry, you guys. So that's not a lucky thing. Like, when people have this narrative that he got lucky at Chewy, they don't understand what this is about. Like, and 6 years, that's nothing to grow that business to that massive amount of to that kind of scale, right? And from 10 million or 15 million, what is the seed money? Hold on, I keep forgetting to, okay, hold on one second. So if you look at the seed money to start, Chewy seed money. So, hold on, Mr. Chewy, no. Funding and financial. Okay. Co-founder. To financing. Okay, so this article right here. Okay, most people, it's 6:14. Okay, well, let's listen in since I'm a terrible reader here.
You're listening to a Noah series, where we guide you through a topic with thought-provoking audio articles from the world's best publishers. In this series, we've handpicked a selection of articles to help bring you from A to Z. Be sure to follow the series if you wish to stay up to date when new articles are added.
You are listening to Harvard Business Review. In the January-February 2020 issue, Ryan Cohen, founder of Chewy.com, writes the How I Did It section on finding the financing to achieve scale. Most people assume that the high point of my professional career came on April 18, 2017, when the owners of PetSmart paid $3.35 billion for Chewy.com, the pet retailer I had co-founded 6 years earlier. No doubt that day was incredible. It represented the culmination of a dream and a tremendous amount of work. But believe it or not, another handshake, another deal, mattered even more to me. That one happened on September 26, 2013. I'd launched Chewy 2 years earlier with Michael Day, using our own cash and small loans. But my vision was to build a large business, and I knew that significant capital would be required to finance the growth. We approached dozens of VC firms. I even flew out to Silicon Valley from our South Florida headquarters and went door to door on Sand Hill Road explaining how Chewy would succeed by delighting customers and running an ultra-efficient operation. But everyone turned us down. Larry Chang at Volition Capital was one of the people we pitched our company to. We first met him in 2012 when he was en route to Disney World with his family and agreed to make a quick stop at our office. I remember that he asked me, who's going to take this company to $100 million in sales? I was 26 and probably looked even younger, but I confidently answered, I am. He didn't invest. He followed up with us about 6 months later, though. We'd beaten the sales projections that we'd previously given him, and he was impressed. A few days later, he signed off on a $15 million investment in Chewy. The satisfaction of that victory was even greater than the pride I felt following the eventual multi-billion-dollar sale. After 2 years of building Chewy, and more than 100 conversations with VCs that went nowhere, I'd finally found someone who believed in me and our business model. Larry had validated our idea. From that point on, the mission was larger. I was even more committed to making Chewy an industry leader, because it was no longer just our own money on the line. Larry had gone out on a limb for us. I felt that responsibility. I approached every subsequent round of financing, including PetSmart's acquisition, in a similar way, by under-promising and over-delivering on sales. Our mission was straightforward, to build a best-in-class, customer-obsessed pet retailer. We also wanted to leave everyone who'd backed us a winner. I've been working since I was 13, when I started building websites for family members and local businesses. From there, I moved into affiliate marketing. I met Michael in an online chat room discussing website design and computer programming. We hit it off immediately and started talking about collaborating on a business. I'd always wanted to build an e-commerce company, so we settled on what we thought was a terrific idea in an industry ripe for disruption, online jewelry sales. We built the website, set up the delivery systems, bought the inventory, and even put a safe in the office to store it. But about a week before our scheduled launch, I had a revelation. I was in a local pet store with my toy poodle, Tylee, asking the owner about the most healthful food I could buy for her. That's when it hit me. I was getting into the wrong business. I didn't care much about jewelry, but like many dog and cat parents I knew, I was passionate about what I bought for Tylee. The pet industry was big and growing. Moving from mass market to premium, it was clear that the opportunity was huge. So, although we were only a week away from launching the jewelry business, we pivoted. We sold all the rings, necklaces, and bracelets, and the safe, and started learning everything we could about the pet industry. We built a new website. We found a local distributor and partnered with a third-party logistics company nearby. In June of 2011, we launched. In just 3 months, we went from my epiphany at the pet store to running a pet supplies business. We intended to build a best-in-class, customer-obsessed pet retailer. People sometimes ask if I worried about following in the footsteps of Pets.com. In 2000, one of the highest profile failures of the dot-com bubble. I didn't. For one thing, I was 15 when that company declared bankruptcy, so I wasn't very familiar with the story. Second, Pets.com existed at a time when most people had dial-up internet and weren't comfortable making purchases online. By the time we started, e-commerce was second nature for most consumers. I also got questions about Amazon, and of course, it was a real competitor. It had an incredible infrastructure, established relationships with customers and suppliers, and endless capital. But I knew that other companies, including Zappos, later acquired by Amazon, and Wayfair, had found success in specific product categories. Their secret was offering a differentiated customer experience. I thought we could do something similar in the pet space. With limited resources, we served as our own C-suite. I was CEO, Michael was CTO, and my longtime friend Alan Attal was COO. We knew that superior customer service had to be one of our core competencies if we wanted to deliver the same experience I'd had at the neighborhood pet store. So our first priority was building a team to work the phones, live chat, and emails in our call center, so that we could stop doing all that ourselves. From the outset, we reinvested all our cash from operations in the business, but eventually we needed the larger pools of money that VC firms offered. After months of searching, we finally found Larry and Volition. We closed the Series A financing round on October 24, 2013, and I'll never forget the moment the money hit our bank account. Although we had signed the term sheet, part of me was still skeptical that it was all going to work out. But when I saw the transfer confirmation, it became real. With that money, we could invest in developing the systems, technology, and teams needed to scale up. We could also bring stocking and shipping in-house. We already recognized that if we wanted to create a multi-billion-dollar business, fulfillment had to become another core competency. Consultants had told us that it would take a year and a half to build a warehouse from scratch. But with 300% growth year over year, we didn't have that much time. The logistics company handling fulfillment couldn't keep up. So the Chewy customer experience had begun to deteriorate. We needed more control and fast. We knew we had to make the transition within a few months. We started scouting potential sites in February of 2014, focusing on the northeastern United States because so much of the country's population lives there. The location we chose, Mechanicsburg, Pennsylvania, would allow us to provide overnight delivery to customers in the densely populated tri-state area of Connecticut, New York, and New Jersey. By that summer, we'd opened a 400,000 square foot facility full of bags and cans of dog and cat food, carriers and cages, leashes, litter boxes, toys, and treats. Although we managed to get up and running in less than 6 months, it certainly wasn't easy. Everything that could go wrong did. We couldn't hire people to work in the warehouse fast enough. When we were finally staffed, the scanner guns would stop working, or the Wi-Fi or warehouse management system would go out. We were tackling issue after issue 24/7 until we worked out all the kinks. We also focused heavily on marketing. From day one, we invested almost exclusively in direct response ads, so every dollar spent could be tracked. No Pets.com style Super Bowl commercials for us. We expanded by investing in the team and processes to effectively acquire the right customers at the right cost. Our governor of growth was free cash flow. Our sales more than doubled from $205 million in 2014 to $423 million in 2015. Our new hires played a big role in scaling up the company. I realized early on that I'd need to use my time efficiently and focus on hiring. At first, recruiting was a challenge. Alan and I spent countless hours reaching out to candidates on LinkedIn, explaining how quickly the company was growing and describing what we intended to build. But 98% of them didn't bother to respond. Surprisingly, that turned out to be a useful filter. The 2% who did write back were true believers, team players, and business builders who were excited for the opportunity. They all had tremendous heart, fire in their bellies, and a will to win. We hired for passion. Many people quit stable jobs and relocated with their families from across the country to join us. It was a tremendous sacrifice that we never took lightly. Ultimately, we raised 6 rounds of financing totaling more than $350 million from T. Rowe Price, BlackRock, Greenspring, Lone Pine, Verlinvest, and the investment bank Allen & Company. Our revenue was $901 million in 2016 and growing 100% year over year. That got us thinking about an IPO for our next round of financing. We had about 7,000 employees and 6 warehouses, with plans to add another 2 in the next 12 months. From an operational and strategic perspective, the company was strong. As we prepped for the IPO, Petco, one of the largest U.S. pet retailers, approached us about a merger. It couldn't meet our terms, so we shook hands and parted ways. In early 2017, PetSmart, Petco's primary brick-and-mortar rival, also reached out. I received an email from Raymond Spider, a partner and the chairman of BC Partners, the private equity group that had completed its acquisition of PetSmart in March of 2015. He said he was interested in buying Chewy and wanted to talk. We had met previously but didn't know each other well. PetSmart was one of our top competitors, so we proceeded carefully. I explained that we were preparing for an IPO, so we expected a certain price in an all-cash public-style deal. In view of the competitive dynamics, we weren't going to give away our proprietary information and start a lengthy due diligence process. I told Spider that if he wanted to make the acquisition, he would need to do it quickly. To his credit, he did. In April of 2017, we signed an agreement to sell the company for $3.35 billion. It was the largest e-commerce acquisition in history. Our investors were happy too. The early stage ones made huge gains, and the later stage ones earned significant money. Investing in Chewy had made a lot of careers, and I'm proud of that. Those investors put their trust in me and my vision, and I repaid them with returns. The same would soon be true for BC Partners and PetSmart. Chewy's revenues continued to rise post-acquisition, hitting $3.5 billion in 2018, while its losses narrowed to $267 million. In June of 2019, PetSmart spun Chewy off into a publicly traded company at a valuation near $9 billion, close to 3 times the sale price only 2 years before. I left the company in March of 2018. It wasn't an easy decision, but I felt I had done all I had set out to do. The company was sound, the foundation strong, and the vision set. But I was no longer in full control, and I didn't want a boss. I'm a business builder, not a manager. My work was complete. When I think back to why raising the money to help grow the business was one of the best moments of my life, I realize it's because the journey was far more exciting than getting to the finish line. I relished the challenges of disrupting an entire industry and trying to delight customers to a degree that had never been achieved before. The excitement I felt from putting together a world-class team of employees and investors, succeeding against all odds, and building a multi-billion-dollar retail leader from nothing was unequivocally the greatest of my career. You were listening to How I Did It, from the January-February 2020 issue of Harvard Business Review, written by Ryan Cohen, founder of Chewy.com. It was read by Sam Scholl for Noah.
Congratulations.
So there you go. And if you read that article, this is again was written by Ryan Cohen, and you still think that this guy is just like lucky at what he does or did for Chewy, you are mistaken, immensely. And here's what the last thing that I got from this. I hope you enjoyed that one. Sorry, this guy read better than I could ever imagine. But it sums up, the personality of Ryan Cohen, right? He's just enjoyed the journey of building something disruptive, right? Of to the degree of achieving what he's never done before, right? So that's what he's going to try to do for GameStop. What makes you think he's going to do something else differently? Then this is why he's devoted. He's devoted to this company to the point where he's not going to take any salary, to the point where he's not going to go anywhere but GameStop. Until GameStop succeed, he's not going to go anywhere. And the fact that they want you to believe that Ryan Cohen is going to dump GameStop for any other company like Bed Bath & Beyond and all that stuff, that is just a narrative that they want you to believe, because Ryan Cohen is the real deal here, and GameStop is the company that he choose to do this once again, to build a multi-billion dollars retail leader. So he's planning to make GameStop the leader for gamers, obviously, right? And again, none of that really matters. Again, this is just the personality in the past. I'm not saying he's going to be able to achieve that. I'm putting my money where my mouth is, right? That I believe that he could do that. Again, I'm not saying that he's going to do the exact same thing or even better, right? Just because they succeed once doesn't mean that they're going to succeed again. I understand that. But at the very least, he has a better track record than any other person, right? As a CEO, as the chairman for this particular company. I'm level-headed. If suddenly I see Ryan Cohen buy a private jet for GameStop or just blowing money left and right against what he is saying in the shareholder or annual shareholder statement that he had, a short statement, then I'm going to reevaluate it, right? But up until this point, he hasn't done that yet. And I've seen nothing but improvement based on the balance sheet, not the price action day to day, but the balance sheets, the fundamental of the company. And I'll show you in a minute what I mean by that. Anyway, so whose balance sheet doesn't lie? Yes, Lionel. Okay. Cool. But anyway, so let's see. So he sold it to PetSmart for, remember, this is the highest valuation of a IPO or at the initial or what is it? Highest valuation, when it comes to IPO, right? Or being said by any onset of buying from when PetSmart buy it at that price was the highest valuation ever. And that's not being achieved any lightly. That's not luck. When people say that he's lucky, it's like, what the hell? Anyway, at the end of 2020, Ryan Cohen spent about close to $100 million, $76 million buying. Now, he didn't spend that much on the onset, but, over time, he's going to it add up to that amount. Buying 13% stake in GameStop, while urging management to restructure and railing brick and mortar. Ailing? I don't know. The ailing? Oh, meaning sickness. Ailing. It's hard for me to say that word. But anyway, so he urged management to restructure the company. He joined the board of directors. He joined GameStop boards in January 2021. So again, even he didn't even join the board until January of 2021. So that date is important, so I'll show you why in a minute. And his fortune surged that month after Reddit trader coordinated a massive surge in stock price, right? the son of a teacher and a glassware importer, Ryan Cohen started his first business at the age of 15 years old. Okay. At the age of 15, collecting fee off of referrals to e-commerce site. So, being a businessman is in his blood. And that's why, he's going to be fine. And he's going to do wonder for GameStop too, just so you know. Again, this is just my personal opinion here. You might believe differently. So, okay, so he's, pretty young, so 38, investment self-made, there you go, he's a self-made. And in that article too, he's not there to do what other people are telling him to do. He's well capable of doing something. That's why he stepped down from Chewy as a CEO, because he doesn't like being told what to do. And this is, the type of people that you want, because he's a born leader, right? He's not the type to to follow orders, right? He's a trailblazer. He's a leader. So that's what you want in a leader. And not a radical one, obviously. He has his track record to show you what he's been doing. And it's the other quote that he's always that I respect that it was on that article was that he's always under promise but over delivery all the time. Under promise on whatever he's doing, but going above and beyond in order to, over deliver every single time. And that's the leader that you want. You don't want somebody who just boasting around, oh, hey, I could do this. Just like Adam Aaron in AMC. He's always like, oh, we're doing the greatest, and we've done this, we've done that. But then the result doesn't speak for itself, right? It's just falling short. It's just salesman after salesman. While Ryan Cohen doesn't sell you anything. He's just telling you, hey, this is what happened in the company. This is what I want to do. Not quite sure how I'm going to get there. But here's the result that I've been doing so far. So let's look at the result that he had. Let's see. Did I show you this? Yeah, I think I showed you already. So this is the reason why I know what date he was involved in. So that's also an important date right here. Again, at this point, he had no control over the company. It's just the prospect of him owning 10% of the company at the time. Again, it was a lower price at that time, so that's why it was the opportunity was to obtain that company for a very low price at the time. So at that time, of course, Ryan Cohen saw the value of GameStop. So this is the year in which he was able to take control, and this is the end of the year in which he was writing to the board of director. At that time, before that year, GameStop posed a loss of $600 million right there. $673 million right there. Why? Well, because of goodwill, right? We all know that. Look at this. Operating expenses jump up $1 billion. It's not that they're spending left and right. Look, if you look at the revenue up here, revenue $8.2 billion in sale, but the gross profit was there. It's not that they're from this year to this year, there's no discrepancy of $1 billion. That $1 billion comes from goodwill impairment. Okay, so why it's jumped that way? If you look at the goodwill at that time period right there, 2018 to 2019 right there, 18 to 19. If you look at the goodwill, keep clicking the wrong one. So goodwill right here, boom, right? And then you want to go to the year 2018 to 19. You see this? From here to here, that's $1 billion. But even a year before that, it was another $1 billion goodwill burn. So if you look at that one, let's look at that one together again. Income statement 2017 right here, right? 17 operating income right here. So if you look at the operating income, you see this? From here to here, operating expenses. From here to here, okay, there's no difference in the jump there, but it could have been lower, like $1 billion, right? Instead of like around this price point right here currently. So hold on. So the operating expenses should have only been maybe close to $1.3 billion or $1.2 billion here, but instead it's that much because of the goodwill burn. So what am I trying to say? So if you look at when did Ryan Cohen kind of got the ability to steer this ship along, is right here, around this time right here. If you look at the operating expenses, right? Yes, it's jumped up last year, and then it jumped down 100 million. But again, this is Matthew Furlong, right? Ryan Cohen just got in here at the end of the year as a CEO. Obviously, he was a chairman. He was not involved in the day-to-day. But Matthew Furlong did a pretty good job at, kind of bringing the costs a little bit higher. Again, like this is when the transition was up in full swing, right? And so one of the things that you're looking into, so if you look at the previous year, 2020, right? If you look at that, okay, 400 million right there. This is when they burn the goodwill value. And then this is another burn, but they still come in positive in the year right here, 2018. But remember, their goodwill was burned from 17 to 18, another $1 billion, right? If you look at that goodwill, 17 to 18, right? 17 to 18, went from 2.2 billion to 1.8 billion, 1.4 billion, sorry. So that's a difference of around $800 million right there. $800 million, the difference right there. And so it has nothing to do with the day-to-day, the day-to-day operation of things. Again, if you look at the shareholder equity, and this is where I kind of want to show you without the goodwill value, Now, goodwill is like an intangible asset that you could put on the balance sheet in order to prop it up, right? Now, on a rule of thumb, if you want to invest in some company, it's better off to have no goodwill value at all because, again, you cannot resell it. If you look at the definition of goodwill, it is an intangible asset recognized when a firm is purchased a ongoing concern. Wait, hold on. Sorry. When they purchase a company and they overvalue it in some way, right? Because of the future cash flow of that company. So it's arbitrary being thought of as $2 billion. So in the example of Gamestop, they must have bought some company that was valued at, $1 billion in asset and all that stuff. But then they have an intangible, asset in terms of future cash flow. But then, it's just an accountant trick in order to get you to see, look, oh, we have 4 billion dollars in asset. But in actuality, you're supposed to subtract that from the goodwill value, right? Now, if you subtract the goodwill value from the shareholder equity from the previous years, again, 2009 right here, shareholder equity down here, $2.2 billion right there, right? But if you subtract it from goodwill, you would only get around $100 million of shareholder equity. This is the onset of the company. So $100 million, that's it, shareholder equity. Again, not accounting for the goodwill value, right? The same way, if you subtract goodwill from here to here, the 2010, you get 500 million right there, right? Subtracted, you get around 500 million. Subtracted, you get 1 point something billion dollars. Okay, a little bit better. Again, I'm just ballparking, okay? I should have done this math, but whatever. I might just record a separate video on that. But if you subtract it here, 2013, again, this is back in the heyday of GameStop, okay? And people argue, oh, GameStop used to be, making a lot of money and all that stuff. Well, it really doesn't matter. If you're a shareholder, you care about shareholder equity, right? Now, the net income, it could be worked out. Again, it's a matter of scale. It's a matter of whether you have the ability to generate that income, right, in the future. Again, future cash flow is everything. And GameStop has been a positive cash flow for 3 executive trailing 12 months. Don't believe me? I'll show you in a minute. But anyway, so you have goodwill right here, $1.5 billion minus $1.2 billion. That's around $1 billion. So $1.2 billion, right? Okay, hold on, let me do that math. Okay, 1.28 minus the goodwill value, 1.53, not even $1 billion. So there we go. And then if you do the same thing here, not even $1 billion, not even $1 billion. Again, this is 2015. If you move along, stay with me a minute, if you move along, there you go, $200 million, not even 200 million if you subtract goodwill from shareholder equity. This year, 2017, even worse, because again, they were burning goodwill value so dramatically. And, the asset is not, it's being propped up by the goodwill value, okay? And then in turn, you also prop up the shareholder equity as well. So if you were to subtract it, what do you get right there? Not even $13 million or something like that. Hold on, let me do that math real quick. 0.254 minus 2.232. See, that's like $2 million shareholder equity at this moment in time, right? Again, it fluctuates, but I'm trying to show you that without the goodwill value, this shareholder equity is going to be decimated. And you're going to see it in a minute as well. And then back in 2018, obviously, if you subtract that, you're going to get, let me see, 2.214 minus 1.4. So $700 million for 18. What do you get here? Without the goodwill value, that's going to give you around $900 million, right? So as they start to burn more goodwill, right now, right here, Ryan Cohen, jump in here at the end of this year, November 16, right, 2020, no more goodwill to burn. That is the opportunity right there. So I bet you anything, he probably saw that. It's like, hey, there's no goodwill to burn. This is the best opportunity. And the price at the time was very low because of that, whole scenario of shorting until, to oblivion. But when they short GameStop to oblivion, look at the shareholder equity without goodwill is. You see this? $611 million. So you're telling me at that price right here, 600, this is the shareholder equity right there. If you look at the price back then in 2000, right here, and this is where the opportunity was before, November 2020. Okay, this is when people were like, hey, GameStop is undervalued. Why? Because at that time you could buy the whole company for $200 million, right? $250 million, something ridiculous. Well, let's do that math. What was the lowest one? So at the end of that year, November, at the end of this year, well, throughout this whole year, let's look at the lowest one. Of course, I'm going to look at the lowest one. Lowest price point was 84 cents. So say, no, 64 cents. Let's say 65. 65 cents times the amount of shares right now. Of course, like this is post-split. So bear with me there. So you're telling me that I could buy the company in less than $200 million. In less than $200 million when the company at the time, and again, this is at the lowest price, if you get lucky enough to buy it at that price, you're telling me that shareholder equity alone was 3 times the amount of shares. 3 times the amount. And that's why you see that buying spree, because people saw the value, number one. Number two, now you have Ryan Cohen got in. So Ryan Cohen saw that opportunity and he bought it at like $500, sorry. Hold on. So Ryan Cohen, if you look at, I think it's around $4 a share, right? Even at $4 a share was amazing. So he wrote the letter at this time, and I think sometime he kind of posed as SEC filing that he bought more. So he bought around, let's say, at the highest, let's give him the highest price because, that's overestimating it. So 5, and then if you look at the whole share right now, oops, actually 0.5. So he bought GameStop at the valuation of $1.7 billion. So he bought it more expensive than, the rest of the people, but, earlier people, obviously. And I'm not saying that most of them are still holding, because I have no way of knowing that. I'm sure some of them sold out, at the very top and, kind of get rich off of that. But that is to say that at the time it was undervalued. And that's why GameStop went up. Not because Reddit people, they just, band together and buy. Yes, some of that happened, but there's also another market mechanic that happens in the background as well that, people don't really understand. Again, why did they remove the buy button? And it's not just Robinhood, it's all of the TD Ameritrade, Charles Schwab and all that stuff. Like they limit the amount of shares that you could get for GameStop. And of course, they do that to protect, the insider, right? The people up top. And so this is the history of GameStop, right? So let's get to what Ryan Cohen is able to achieve at this moment in time, right? If you look at that. So, okay. Actually, let me take a short break real quick. I will be right back. I'm gonna put some music on here. All right. Okay, I'll be right back. Okay, so got some water with me right here. Okay, let me take another sip. Okay, so back to what I was saying. So if you look at the shareholder equity right here, right? $611 million in shareholder equity after the burn of goodwill. So at this point, there's no goodwill to burn. Ryan going to step in as the chairman right here of this year, January of this year. Immediately, obviously, there's some shake up there, obviously, but then the following year, they were able to increase the cash value to $1.2 billion from, 600 million. But on top of that, they increased the value of shareholder equity as well. And without goodwill. Let me say that again. Of the history of GameStop shareholder equity. These 2 years has been the highest it's ever been. It's never been this high. 1.3, 1.6, whatever, right? Now, people probably saying, oh, well, because they are able to, dump on retail. That's why they were able to raise money. Well, yes, they did dump on retail, but to make the company better. And when I said they, it's not Ryan Cohen. It's the company itself. They need some money to survive or to thrive, right? At that time, the reason they did that is because it was overvalued at the time, right? To $400 a share, they were able to take advantage of that by, selling a couple millions of shares in order to get that $1.1 billion in the cash on hand in order to increase the shareholder equity right there. So again, these 2 years has been the highest shareholder equity in history of GameStop. Keep in mind too, this is 2003. We still have 2 more quarters to go. So again, those numbers still remain to be seen. Currently, we have a retaining loss of $200 million. Not too bad, but last year we didn't have any retaining loss right here. So, in fact, we did make $93 billion right there in retaining accumulative or retaining earnings, right? So again, we still have 2 more quarters to go, and this is the year to behold. But if you want to look at the previous year, obviously, when Ryan Cohen stepped in as a chairman, we see improvement right away. The asset to $3.5 billion, and then subsequently, obviously, it went down a little bit, but I mean, you still have the shareholder equity higher than it's ever been in history without goodwill, right? So as far as this quarter, we are looking into the third quarter, and I think that they're gonna try to beef up the inventory again. So last year from last quarter, if you look at the last year quarter 2 to quarter 3, right? Again, like I'm looking at the month up here, right there. They were kind of increased inventory, $400 million in inventory increase. So I don't see why not doing the same thing, or at least kind of similar, right? Perhaps adding more inventory to that to the next quarter. So next quarter might not be profitable because of that, showing a loss again. I don't know. Again, that's based on my own speculation here. Not to say that they're not profitable in some other way. It's just that I think they're going to use most of the profit from here to go into buying more into the inventory. So it's going to be like 1.2 or even $1 billion, in order to sell as much as they can, and to increase that, value for shareholder equity, to create, that service base business. To create, some incentive for people to come in at a very low price, right? So that's one. And then I think one other thing that I want to mention here. Let's see. Okay, 1 second. So if you do the quarter, right here, net income, we are going to not, hold on, let me see, 10 right here. So we want to beat this number right here. We want it to either stay flat or kind of even $50 million $50 million loss. That's also a good thing. Anything lower than this number is still good. But keep in mind as well, at that time, you have the SDG&A right here. SDG&A. SG&A right here of, a very different SG&A. So we want to kind of make sure that that number is still the same or slightly higher. We don't want it to go to this price point right here. But even if he could decrease it by more, that would be amazing as well. So it's coming up in a couple weeks, so I'm excited to see that. But see, last quarter we only lose 1 cent. A lot to be excited about. Let's go back to the chart of GameStop here. I know I'm all over the place here, but bear with me. Now, one other point that I want to point out. Now, I pointed this point out before, but just in case you didn't get to hear. When I hear people saying GameStop doesn't make money, GameStop lose money, GameStop is not profitable, GameStop is this and that, right? Or they're going bankrupt soon. I always wonder, how is it that they estimate that GameStop even make money, See, revenue right here, $2.1 billion right there. And they keep estimating it at a very high valuation, or at least revenue coming in every quarter at a very high spot. Why estimate so high if they're not making money, if they're not making sales and all that stuff? So again, even through the high expectation for quarter, I think this is quarter four actually. This is quarter four of last year. They still beat the estimation, right? And so this year, I bet you anything they're going to beat it again. If you look at the estimation, this is third quarter estimation, $1.18 billion. What is 1.8 billion come from? I think it's coming from this right here. So last quarter, we didn't beat the sale, but it seems like they make a overestimation right here. But the revenue, was too high for them to obtain. I don't know if they actually overinflate the estimation in order to make, GameStop look bad at that time. I don't know, but this is a subsequent. Anytime there's bad news, it's kind of crashing down like that. But good news, they rock it up after hours just to bring it right back, within the month or so. So this is like a whole month, right? Yeah, like a whole couple months right here. Again, this is a daily candle. But you see like how they overestimated, but last quarter they beat every expectation right there. Even on the inflated price of the estimation for GameStop sales. So again, we're in a good standing here. So let's move on to Walmart. Now the reason why I bring Walmart up is because of this. See, you see this drop right here? This is 8% drop right there in a day. And that's a sign of trouble, right? And actually 9% right there. 9%, close to 9% drop right there in one day. And again, people are just propping it up and saying, oh, Walmart is good standing. People still continue to shop there and all that stuff. It's BS, right? And to me, if you look at the goodwill value for Walmart, I wonder what the goodwill value for Walmart is. I've never taken a look at it myself, so let's take a look at it together. Now, I'm not saying this is a bad company. Obviously, this is a staple and all that stuff. But I'm just curious on what's the, see, look. Goodwill value. it increased every single, decreased from last year, but $28 billion in goodwill, right? So if you subtract that from the shareholder equity right here, see? The reason why you want to subtract it is because you don't want to evaluate the company on an overinflated price, because again, goodwill is intangible. You can't touch it. You can't resell it. There's no resale value for the intangible asset, with the exception of it being cash flow, right? Or used as a cash flow, or just propping up the balance sheet so that, it looks better, for people who doesn't know where to look. So if you were to subtract that $28 billion from the shareholder equity, what do you get? You get $48 billion in shareholder equity. $48 billion divided by the number of shares outstanding, divided by, ignore the minus, divided by 2,690,000,000. That's the amount of shares being, but then this is a billion, right? So, hold on. I'm trying to determine what's the book value for, hold on. 2 point, yeah, there you go. Because it's expressed in billions, so. $17 per share. Let's say $18 per share on the shareholder equity without goodwill. So $18 a share is the book value for this company, right? What is the book value for GameStop? It's $4 a share. And so if if this is the book value without the goodwill, then Walmart is heavily overpriced, right? But did anybody say anything about how Walmart is heavily overpriced, right? So how many times is that? If you were to divide that by the share right here, but then you inverse it, that's 8 times the price of the current price right now. And if that's the case, and obviously you have, yes, revenues increase, but that's inflationary, meaning that, of course, they want you to buy it. Consensus analysts out there want you to buy into Walmart at this price, even though, there's the signs of trouble. CEO keeps saying, oh yeah, we're still doing well, even though people are focusing on the wants and needs. Now, the only saving grace that I see for this company is the fact that they have high inside ownership, right? But that could change anytime. But yeah, it's Walmart is not going anywhere. I'm not saying it's going to go anywhere bankrupt anytime soon. But as far as growth from here, I don't see it. You see the profit margin is like 2.5%. So GameStop could beat that pretty easily with good leadership like Ryan Cohen, right? So anyway, that is that. So I think that's all I have. Let me end by saying this right here. Obviously, we're still kind of looking to crypto. It's kind of trading flat over the weekend. Today is Saturday. So, there's always a possibility of it going higher. right now, obviously, with all of the macro happening in the world, the conflict in the Middle East is still, high. And so those type of things going to shake up the market pretty substantially. But this thing, it's just the beginning, right? Again, like it cannot be all-time high all the time. And if you look at the history of the price for Walmart, they want you to buy here. Okay, these CNBC people right here, they want you to buy here. Let's listen in to one of the. Okay, let's see what they say here.
A slew of retail earnings this week, and they've given investors an inside look at just how stretched the consumer is feeling. So which are the retail names you can safely buy now, like Gap, I suppose, and which should you be sure to avoid? Let's find out in today's 3 Buys and a Bail retail edition. Here with our trades is Victoria Green. She's Chief Investment Officer at G Squared Private Wealth and a CNBC contributor. Victoria, it's great to have you. Your first buy is Walmart, which was consensus until, yesterday.
Of course they want you to buy here. Oops, sorry.
Flat today after that 8% drop on their cautious consumer outlook. They did beat on the top and bottom lines, strong grocery and e-commerce driving that. So you say stick with it?
Absolutely. They were the only retailer really punished for saying what everybody else said, which was, hey, we're worried our consumer's slowing down. And everybody else, even Target, seemed to be saying, hey, we can lower sales, have less traffic, have slower sales. And they got rewarded up 20%. Walmart grew their sales, grew traffic, and they were punished 8%. It just doesn't make sense to me. Quality company, they lean into grocery. They saw e-commerce expand. That added about 300 bips to their bottom line. And I think if you are seeing the value conscious consumer, Walmart's the place you want to be.
All right, you want to be in Walmart. You also like Ross Stores. They just reported, the off-price retailer, and they did top street estimates on both the top and bottom lines yesterday. They had robust demand at discount outlets. They had easing freight costs heading into the holiday shopping season, and the shares are up 8% right now.
Yeah, Ross is definitely one that I would hold or buy because, again, it's about the value they're providing their customers and their ability to grow their top line. They expanded margins. They grew EPS. They still have a very conservative guidance and outlook. And it actually seemed, if you read through management commentary, they're saying, hey, we're going to keep that guidance 1% to 2% sales growth for Q4. But if they do what they did in Q3, that could be up 5%. And their EPS growth, regardless, they range it from 1.52 to 1.61. That's still about 20-30 cents growth over what they saw in Q3. I like a company that's growing, and again, it's value oriented. They saw a little bit lower ticket prices, but people were putting more items in the basket. So we're seeing their consumer look to them for value. And so if you're squeezed again and you're looking for clothing, you might be looking more to Ross than you would to say Target or TJ Maxx.
All right, your third buy is everyone's favorite. So, I got to find some holes to poke in this story, even as I have another order on its way to my house right now. Costco, they don't report Q1 until mid-December, but they did hit a new 52-week high earlier this week, even as Walmart was down, and Amazon too. And their competitor BJ's reported this morning it was a beat on both the top and bottom line, thanks to membership, traffic, and market share growth in Q3. It has to come from somewhere.
I have to, full disclaimer, I am also a Costco lover and a Costco member, but they just have a cult following, and they have 130 members, and they're cracking down on those members. I don't know if you've been there recently or not, but they're actually checking the picture on the card. Mm-hmm. That could drive further and further membership gains, which is a solid out to their bottom line, about $4.2 billion a year in membership revenues, and their store traffic has continued to grow. I think, again, on the value theme, if you're seeing shoppers load up for the holidays, buying food, buying wine, they've got great grocery selections, you're going to see more and more traffic go there, and that would be potentially pulling from, say, a Target or a Kroger as you're looking for those value deals at Costco, those bulk deals to feed your family over the holidays. Yes, October sales were a little bit slower. I think their same-store sales and traffic was up only about 2% versus the 4 to 5% they've been doing earlier this year. But I think they can still have same-store sales growth and justify their premium multiple. Absolutely.
I always thought it would be a cool thing to do as a household, Victoria. We can't buy single stocks with so another one. You could buy everything that you pay for in real life and just recycle the cash flows back to yourself, right? So maybe you'd buy Costco, maybe you'd buy, I don't know, Exxon, maybe you'd buy, and just then it goes out of one hand and then it comes back in the other.
That's a good way to justify our spending. Absolutely.
Exactly. All right, let's. Those all three were your buys. You do have a name that you'd bail on, though, and it's actually Home Depot. The shares are up 5% after they reported strong Q3 results this week. But much like Walmart and Target, they did have that weak outlook. A lot of people have been wanting to stick with.
Okay, so let's look at the Ross one here. They want you to buy this one, so let's look into it a little bit. And right off the bat, I was like, inside ownership, very low, 2%. If you look at net income, that's not too bad. That's good. Positive. PE ratio 25. We want it to be 10. Obviously, that's overvalue. Price to book ratio is 9 times. PEG ratio is below 3, so that's good. But if you look at the debt right here, $5 billion debt. So that is a lot. You know why? Because look at this. Interest coverage is in the negative. That's bad. 11. So again, this is why they want you to buy into this, is because it's in trouble, right? Look at the debt to equity ratio. Higher than 1. That's bad. You don't want that. But because they are in retail and they are at least kind of profitable, 8%, that's pretty good as far as like the net income aspect. So they might be able to wiggle themselves out of this. But I don't know. I feel like, they might have to dilute in order to kind of stay afloat. Why is it so high? Other operating expense. Trillion? This is, okay, it has to be a glitch here, right? $13 trillion. Are you insane? How are they able to do this? Other expense. Yeah, it has to be a typo, but hold on, let me see. Because it's like other stuff too. So maybe that's why the interest expenses is so high. So the interest expenses is right here, negative $48 million right there. Interest expenses. If I looked at free cash flow, so at least it's in the positive. That's good. Cash on hand, $4.4 billion. No goodwill, that's good. Shareholder equity, $4.5 billion. But the debt is $5.7 billion. There's no paying down debt or anything like that. They just continue to have that debt there. Cash on hand, obviously, net cash is in the negative. That's concerning because again, you don't want your net cash to be low. As far as the book value, $13 a share. So it's pretty high considering the price right now. Shareholder equity, $4.5 billion. So if you were to do 4.5, divided that by the number of shares outstanding right here, kind of like what GameStop is right now, number of shares outstanding. So they have close to 3 times the amount of share equity without goodwill. So let's see this is a year. Let's see what's the quarters like though. Hold on. Income quarter. So they do a lot of sale. But if you look at the profit, gross profit right there, kind of around what GameStop is. Oh, this is in a year though. Okay, so profit margin is there. If you look at GameStop real quick here, annually, gross for annual GameStop 1.3 gross. For Ross is 4 point, so it's 4 times the amount there. Okay. So, if you were to compare GameStop there to Ross as a retail, Ross is doing better, but in the financial position though, because they have so much debt, $5.7 billion in debt, that's going to be tracking them down. So I wouldn't touch it because of this right here, this metric right here. Interest coverage is in the negative. You want it to be positive 3 at least. So it just means that they're going to go to the shareholder to, either raise more money or dilute the company even further to, expand it. Currently, they have enough cash on hand for now. If you look at the cash on hand, trailing 12 months, $4.something billion, that's pretty good for now. I'm not saying they're going to go bankrupt anytime soon, but I think the interest payment is kind of weighing them down right now. But if you look at the income right here, see net income, it's pretty high. So to offset that, it's not too big of a deal. But still though, it's never good to have that much debt when your revenue is like, what is the debt to revenue ratio? So if you do 5.7 divided by 19, this is a yearly basis. So that's 30% of your revenue is in 30% of your revenue is in debt. But hopefully, they would pay it down. But if you look at the history of the debt, I don't see it being paying down. Current debt. Hold on. Total debt. Debt growth right here. Total debt. 5 billion. Long-term debt right here. So it seems like they've been loading on debt since 2019. Is it a private equity playbook? That's why they, kind of push you to buy into this, because they want you to buy into that debt. Yeah, I believe it. Again, they began to load on debt, expand more and more to try to, expand, extend, over leverage himself to the tilt in order to create this run on the share price, and they get to exit it, on top of retail. All right, guys, that's all I have. Been out here for more than an hour and a half. So hopefully you're entertained. Sorry if you just joined in. I'm sure you're gonna watch in later on. But anyway, so have a great weekend. It's Saturday right now. I am enthusiastic about the earnings, so hopefully we're gonna have good earnings in a couple weeks or so. So you have a great day.